Hello and welcome to our daily show where we talk about personal and financial development. And today we're talking about handling retirement insecurity. There's a lot of that going on around. And so we're going to talk about what to do, how to handle that insecurity that you may be feeling or having related to your retirement account, and what you can do to create more security and certainty to know that you have in place what you need to be able to retire when you want to retire. And so, if you don't already know who we are, we're Martin and Chelsea Matthews. We are married, we're in business together. We have combined 22 years experience in the financial industry. We're founders of M Wealth Group, a financial consulting and investment agency. And we're also authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house. And really, that is our mission, to help you build an unbreakable financial house so you can handle anything that comes your way financially and create the life you truly want to live. And so today, as I mentioned, our topic is handling retirement insecurity. As you come in, please let us know where you're tuning in from. If you like this information and you think that somebody else you know could benefit from this information, please like, comment, share. Ask your questions. If you have any questions, put them in the comments. We'll do our best to answer them live. And take some notes. If you have a retirement account and you have some concerns about it, stay tuned and take some notes, because this will help you.
All right, can you move that forward a little bit?
What?
The screen, just
On my
there. So, all right. So this is actually based on an article in a magazine called Barron's, publication called Barron's, that talks about financial stuff. So they did a study, BlackRock's company with billions and billions and billions of dollars in assets. They did a survey for people who are saving for retirement, people who are already have retirement accounts, companies that administer retirement plans, and asking people. So they did a survey and found out that almost 40% of people who are saving for retirement, through the workplace, feel that they're not on track with their retirement savings. That could be you, that could be somebody you know, that could be your friends, your relatives, your colleagues. A lot of them do not feel like they are on track for retirement. So we're going to discuss that today. And you can let us know, do you feel like you are on track for quote unquote retirement? Whatever that means to you. Retirement is different for everybody. People have different perspectives and views on what retirement looks like for them. But a lot of people in America are saving for retirement. A lot of them are using a traditional retirement account. When I first came to America, I got a job. They told me save for retirement. I didn't even know what the heck that was even all about. But at the workplace I worked at the time, they offered me a 401k. And so I started putting money into that 401k plan. And that's how most people get started saving for retirement. Very little understanding. I didn't know anything about it. And your employer cannot give you any advice on it, on how to invest, what to do with it. So you're kind of on your own trying to figure this thing out. So if that's something that's of interest to you, let us know in the comments, and then let us know where you're at. And we're going to talk about some key points today that can be helpful to handling retirement insecurity.
So the first thing that we want to talk about when it comes to handling retirement insecurity is the three-legged stool. It worked in the past, but now you need some new solutions. So, like, what the heck is a three-legged stool?
So, three-legged stool, it was called a three-legged stool of retirement. It was three sources that made up your retirement income. So you had personal savings. A lot of people would just save money in a bank account. Savings accounts would pay you 6-8%, even as high as 10% at some points between savings accounts and CDs. So people could keep money in the bank and it will actually yield a decent return. So that was one leg of the stool. The second leg of the stool was a company pension. So you worked somewhere for 30 years and then you got a pension plan, which means that they would pay you every month for the rest of your life, no matter how long you lived. And that was called a pension. It was a lifetime income plan. So that made up your second leg of the stool. And then the third leg of the stool was Social Security. So at the time Social Security was founded, I think there was 20-something workers and 29 workers supporting every one retired person. Now it's less than 3 to 1. So it's less than 3 people who are working supporting every one retired person. And people are living longer, so now Social Security is also in jeopardy. So in the next few years, by 2035, they're going to adjust the numbers, probably going to be sooner than 2035. Social Security is not going to meet its full promised obligations, which means they're telling you we're going to pay you these benefits, but they're going to come back and tell you, by the way, we can no longer pay those benefits. We have to reduce the benefits payments to you. So that's those were the three. That's what made up the three-legged stool. Those three sources of retirement income: your personal savings, company pension, and Social Security. And people retired effectively off of that. If people got a pension, they did well in retirement because they didn't have to think so much about how to plan for it. They worked somewhere for a number of years to do that. What's up, Remy? How you doing? So in the 1980s, the retirement landscape started to change quite a bit. It became expensive for companies to continue to offer pension plans. So what they did is they started to shift the responsibility from the company providing your retirement to you providing your retirement. Meaning they started to shift from pensions to 401k plans, or what they're called qualified retirement plans, where it was up to the company to allocate some of the resources and bundle the money together and create a way that that pension fund would pay for all these people who are retiring. So, for example, in the public sector, you still have pension plans, not so much in the private sector anymore. But in the public sector, like if you work in the military and you do full 20 years in the military, you can get a pension. Some government employees will still get a pension. You work for somewhere for 20 or 30 years, and they give you a pension, which is a check every month for the rest of your life. So those three sources worked. Pensions worked for people, but then when it started to become more expensive for companies, and companies did not want that expense or that burden anymore, they said, hey, that 401k thing, let's just make it available to everybody, and then they can set up their own retirement plans and they be responsible for their own retirement. They didn't want to be responsible to help you retire anymore. So they shifted that to you, and now it's up to you to then plan for your retirement. Problem is, most people are not financially educated. So as a result, they're not planning successfully for retirement.
So something that a licensed financial professional used to set up and allocate, where the funds go, now became just handed off to you with no education, no experience, no information really, even just check the box. If you have a job that has a 401k, you've probably experienced this. Here's the options, check the box. Nobody can give you any advice. And so now with pensions not really being an option in many workplaces, and then the savings, if you put your money in the bank, you're not getting 10%, 12%, 5%, not even 1% barely. So those two things that used to be very strong options or very strong pieces of that three-legged stool, and then you put in there Social Security, really like the greatest Ponzi scheme of all, because the way that it works is people are paying in, like if you're working now and you're paying Social Security, that's going to pay the people that are collecting Social Security right now. It's not going to save for when you retire and you need that money. No, that really is the definition of a Ponzi scheme. And now, like Martin said, there's so many less people that are putting into that Social Security tax compared to the amount of people taking it out, and it's just not sustainable. So now you have to learn and look at and apply different options, additional options to look at, okay, that old way of doing things, it's no longer going to keep me sustainable in my retirement years. So what do I need to know and what do I need to do to be able to create that security?
So there's some new tools. There's some new things that's available. You can actually take, so let's say you've gone down a path of having a 401k plan. There's different ways and different things you can do. One thing is if you leave a job, you can actually roll that money out of the 401k plan and roll it into your own individual retirement account. From there, you then have more options. There's a lot of different things you can do with it. There's something called a self-directed option, which means you are personally directing where you want these investments to go beyond just the options that's available inside of your 401k plan. You may not realize this, but have you ever asked who picked these fund options in your 401k plan? You didn't pick the fund options. The company made a certain lineup of funds available to you, and then you picked from that one that made available to you. Well, there's thousands of funds. There's probably 10 or 20, about 20 or so, 25 maybe or so in your retirement plan. Well, out of the thousands, who picked those 25? You don't know that. And so you just kind of pick what's there and what's available to you. With a self-directed IRA, you can do other things with it. One, you can actually use it to buy real estate. It's a little bit more complex structure. You got to set it up the right way and all that, but you can roll your money from a 401k into an IRA, and then you can direct it into buying real estate. So that's something that you can do with an existing plan. A lot of times, because there's more complexities to that, most people just want to have it as a retirement account and not do a whole bunch of different things with it. There are financial vehicles that can allow you to convert your 401k into your own personal pension plan, which means now you can end up having guarantees on your 401k and you can have income that lasts for the rest of your life. So this is something we do a lot with some of our clients. They have an old 401k. Old 401k means it's from an old job or previous employer. They're no longer working there. So now they're eligible to roll that money out into their own individual retirement account. Once they do that, they can then take that and be able to generate lifetime income, which means just like a pension will pay them a check every month for the rest of their life, they can roll their money into newer strategies and options that will allow them to do the same thing with their retirement accounts. Otherwise, you run the risk of running out of money, which happens to a lot of people. They become a certain age, they didn't plan to live that long, and they run out of money. So there's one thing this survey says from Barron's. It's from a company called BlackRock. It's called Read on Retirement Report. And it said that a third of younger people believe they only need $250,000 to retire, because that's the biggest question. How much money do I need to retire? So what do you think about that?
That is not even close. And then also people are concerned about not even being able to get to that.
Yeah.
So the problem here is major too low of a target.
Yeah.
I mean, a lot of people talk about having $1 million for retirement, and that's not even going to be enough. If you're looking at just a dollar amount to get to your retirement, to be able to live off of a certain amount. Okay. And so it really depends on where the money is at, what you're using for it, and how protected is it. But their targets are way too low, and the estimation of effort is way too low. Because if you think that you're going and you're trying to make $20, let's say, and you need $50, and you don't even think you can make $20, then your effort is not even going to be enough. And then you're going to come short of that target that's too low. Like, people are going to be effed up.
Yeah.
They're not going to make it to retirement, man.
So we're here to help you with the right thinking and the right strategies that you can use. So the first thing is you got to start looking at the right targets. Okay. And one thing we say, am I on track? That's one of the things you have to start looking at, but am I thinking about this the right way? We tell people retirement is about cash flow, because what's the point of having money in a retirement account? So you got $1 million in a retirement account. You're not going to go spend all $1 million in 1 year. It has to generate cash flow. So a lot of advisors have this rule that you shouldn't take out more than 4% of whatever you have for retirement. This is the traditional retirement planning model. That you shouldn't take out more than 4% per year to live. So that means if you have $1 million in a retirement account, in a 401k, an IRA, a 403b, a TSP, whatever flavor retirement account you have, 4% means you would be pulling out $40,000 a year. So that $1 million is only going to generate $40,000 a year of cash flow. And the reason for that is so that you don't run out of money. If you take out too much money, you then are 80 years old and you have no money left. So then you have no income for retirement, but you're still living, you still have expenses. So people are saying that they thought they only needed to save $250,000. If you follow that 4% rule, $250,000 means you're living on $10,000 a year.
Like, where would they even get that number?
So, I mean, how are you going to live on $10,000 a year? So people look at the wrong number. To look at
in a van down by the river.
Yeah, exactly. They look at 250,000 because they see it to be like, oh, it's a lot of money. It's not a lot of money when you look at the cash flow. The cash flow from that is only going to be $10,000 a year. So what you need to be looking at is what cash flow is this going to generate? That should be your main question. What is going to be my cash flow? You're not going to spend $1 million a year. You're going to spend the cash flow. So look at what the cash flow needs to be. Otherwise, you have your thinking slightly incorrect, because then you're aiming for the wrong target. So if you have $1 million in retirement or produce $40,000 a year of income, there's financial vehicles that can actually generate higher income than that. Sometimes this is why a lot of people get into real estate, because they will get into real estate. With real estate, with your retirement account, you have to put that money into it. With real estate, you can go borrow a vast portion of that money and generate income off of that. So it's one of the reasons why a lot of people get into real estate. So if I have a real estate portfolio paying me income, I don't necessarily need a retirement account, see, because I still hit my cash flow goal. If I have a business, if I buy a business and a business is generating me income, I don't need a traditional retirement account because I already have a cash flow goal. I already hit my cash flow target. You understand? So, but if you do work in the corporate world and you do work in a place that has a traditional retirement account, you have to have the right thinking about, okay, what is the cash flow going to generate for me? And if you're somebody who has a retirement account right now, one of the things we do is we help people review their retirement account, their existing account. So you got to have an account in place. So why don't you tell them a little bit about that in a little bit point two?
Yeah, so if you have a retirement account in place, could be a 401k, IRA, 403b, TSP, any kind of retirement account. And generally, we have a minimum of $100,000 that you must have in the account for us to do a review. But if you have, we do want to make it available to a few more people. And so if you have at least $50,000 in your retirement account, we would do a free retirement review where we can look at your account, see where it's at, what it's allocated in, and what are some of your options to provide some more security, some more benefits, things like that, so that you can have more security in your retirement. You can request that. Did we change the link?
No, Green has the link. So I think
Okay.
that's the link. I'm not sure if that's
no, it's 6buildingblocks.com/retirement. 6buildingblocks.com/retirement, and you can request a free review of your retirement account.
So you must already have an existing account. Have at least $50,000 in there, because look, if you got $5,000 in your retirement account, it's not really a whole lot you need to be doing differently with it. You just need to continue building it. But when you get to, the more you have in a retirement account, the more strategic you need to be about it. That's when you actually may need help from someone. But otherwise, you may just want to keep building your account, especially if you get a match at your employer. They're matching you, you put some money in and matching you, that's fine. But if you have a retirement account, because, for example, we were talking to somebody the other day, this year they've lost over $60,000 in their retirement account just in the last few months, because they have a decent amount in there and the market's been down and they're not sure what to do. So in that case, this person's trying to figure out, because that could represent a year of their living expenses that they just lost in the last few months. So you want to make sure that you are, the more you have, so if somebody has $1 million in a retirement account and they have a 10% drop, that person just lost $100,000. So it becomes very important for you to be very strategic the more money you have in your traditional retirement account.
And if you don't have a retirement account, or you need some ideas and resources on how to start building a retirement account, or you don't like, the 401k at your job and you want other options, you can reach out to us as well. We have tons of resources.
Yeah.
And also, just so you guys know, we go live every day, Monday through Friday, 9:30 a.m. Eastern. And for those of you on Instagram, also, we do go live on YouTube. And a cool feature of that is that you can actually minimize the screen, so that if you need to do something on your phone, you don't have to log out of the stream. You can still have it playing, do the thing you need to do, and then still be listening. So that's a cool little feature. And we have, if you're not subscribed to our YouTube page, you can go to the link in our bio and you can go to our YouTube page and subscribe there. Thanks for the tip, Ian. I think that's your name. All right. So anything else?
No, let's go to the next one. Next point.
Oh.
Do I point two, protecting? Yeah.
Oh, okay. Number 2 is protect from losses and taxes. Some vehicles, including even life insurance, allow you to do this.
Morning, Dwight. How you doing, buddy? So look, when you are thinking about retirement, retirement planning, one of the biggest things you have to do is make sure you protect from losses and taxes. So here's what's happening that the government doesn't always tell you. When the government prints more and more money, we incur bigger and bigger deficits, which means we owe more and more money. So the national debt goes up, up, and up. When that happens, the only way the government raises money is through the form of taxes, or they increase interest rates. They print a lot of money, which then forces price to go up. And then they have to raise interest rates so price can stabilize and all these different things. They do lots of different things like that because they're trying to contract the inflationary effects. When those things happen, you pay an indirect tax in the form of inflation. Inflation is an indirect tax. So now they can tax you directly, which is what a lot of them are trying to do. So when it tax you more, people who have traditional retirement accounts feel that hit. Because, for example, your 401k isn't taxed until you take the money out. So you don't know what tax rate you're going to be at when you take that money out. So that means, and it's counts as ordinary income tax. So when you start taking that money out, whatever the government decides tax rates are at that time is what you would have to pay. So that is your 401k, traditional IRA, things like that. So you want to make sure that if you have a substantial amount or you're building towards a substantial amount, that you protect from losses. Very important. The more you lose, the more you have to gain just to get your money back. And we're talking about retirement accounts here where you don't want to lose a lot of money. You want to continue to build in a solid and stable way. We talked about the 3-legged stools of retirement. One of them was a pension. Whenever people got pensions, they didn't have to worry about investment losses because the pension fund handled that to be able to do it. Dwight asks, is over 50 years old a disadvantage or too late for me to put over for retirement? No, not necessarily. Some people start at 50 depending on where they are. The strategy might be a little bit different because the focus would then be on like income. So let's say somebody is their goal is to generate, let's say $50,000 a year of income. In order for them to do that in a traditional way, they would have to save like 1.2 million. And so that may seem like a large amount because they're going to take out 4% a year. So that may sound just undoable for them. So they have to look at it. Okay, my goal isn't 1.2 million. My goal is 50,000 a year. So what are some other ways I can reach this 50,000 a year? And it could be that they can do things like real estate. They might buy a rental property. They might save some money. Maybe they save 25, 50 grand and partner with, 4 other people. Now they got $100,000 and maybe they go and start buying some duplexes, some fourplexes that starts generating income. So maybe they do that once and maybe they get $500 to $1,000 a month of cash flow. Now they got 25%, not saying 2, but 25% of their cash flow goal done because that property might produce a portion of the cash flow. All right, so now they've done that. They may refinance the property, pull out equity, and buy another property. Or they could do something called a 1031 exchange into a larger property, defer the taxes on there, and generate more cash flow. So now they got a bigger property. And instead of it paying them $1,000 a month, maybe now it's paying $2,000 a month because it's an apartment building. So now they're 50% towards a retirement goal, right? And so somebody could do that very easily in a 10-year period to where they can build assets that pays them that $50,000 a year recurring income. So they have to think a little bit differently and have the right goals. Otherwise, if they go to we've held a bunch of different investments and securities and investment advisory licenses. The traditional financial advisor will tell you, you need to save for retirement in a retirement account, and you need to have this much money in your retirement account so that you can have this much income.
Blah, blah, blah.
The reason for that is because that's mostly what they offer. So most financial planners or people who sell mutual funds don't talk about real estate. because that's not their deal. That's not their specialty. They tell you to put your money into this mutual fund, but then you have to save 1.2 million just to get $50,000 a year of income based on something called a 4% rule, which says you shouldn't take out more than 4% of your income per year. Well, that's very, 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 very freaking hard to do, especially if a person is around 50 years old. So they have to start looking differently at the cash flow target. And then real estate often is a faster route to hitting a cash flow target. So good question on that. One of the things we also talk about, some vehicles people can use is life insurance, especially for tax purposes. So one of the things we do is we store money inside of life insurance policies. We then store that money. That money earns compound interest higher than you would get at the bank, and we can borrow against it. The reason we do that is, so let's say I put $50,000 of cash in my life insurance policy, and then I can turn around, take a $40,000 loan against it. Now I put that $40,000, maybe I flip a property, do something different with it. So now I got $50,000 in one vehicle earning me interest, and I got $40,000 that I put over here also earning me interest. So technically I end up having $90,000 because I leveraged the original 50 I had. So using life insurance as a strategy that way allows people to potentially maximize their ability to, it allows them to use leverage. Have your money working in one location, leverage it, and now you have money working in another location at the same time. Both of them earning interest. So that's one way. Another thing people do is they store monies out of life insurance policies for retirement. Why? Because based on some of the tax rules and how you can access your life insurance policy, you can get access to tax-free income during retirement through a life insurance policy. So it's one of the reasons we use it for that purpose. So a lot of people, a person can put money in monthly and just put it in there like they would on any normal account. And then there's some life insurance policies that will pay you. You can actually turn some of the life insurance policy into like your own pension plan. Some of them have features will pay you lifetime income, and that income will be tax-free to you. And some of these life insurance policies, you can do some of them without taking any market risk. So you're actually protected from losses. So you don't have market losses. Some of them pay interest and dividends. You can leverage them, which is borrowing against them to buy other assets, and you have a lifetime income feature that can pay out to you tax-free. So all of these are things that we help people with. So something, if any of you, if you need help with things like this, you want to understand how it works, send us a DM. DM us and say, hey, this is where I'm at. I'm trying to plan for retirement. I'm thinking about this. I have these assets, or this is what I'm trying to do. And we'll help you with the right resource. We have tons of resources and tons of different things that can be able to help you move in the right direction when it comes to planning your finances.
And if you'd like a review of your current retirement account, again, that link is 6buildingblocks.com/retirement, 6buildingblocks.com/retirement. If you have at least $50,000 or more in an existing retirement account, could be from a past employer, your own retirement account, whatever it is, $50,000 or more, 6buildingblocks.com/retirement. And if you're looking at still building your retirement, or you don't have a retirement account and you want some options of what you can do to start planning and building for retirement, then send us a message and we can give you some resources on that too.
All right. So we will be back with you tomorrow. Fed's going to raise interest rates today. We'll see what it looks like. I think it's going to be 0.75% increase like it was the last time. So you start to see interest rates go up. So we'll talk about that tomorrow on our show. But we thank you for watching, and we'll see you guys next time.